The RBA today cut rates to a record low. I have Amber Rabinov, Senior Economist at ANZ in London, on the line. Hi Amber. So many were expecting this cut and you were probably also expecting it, but the real question is, do you think this will be the last cut we will see for a while?
Well, as you mentioned, we were expecting the RBA to cut the cash rate to 2.5% today, particularly following the rather dovish speech from RBA Governor Glenn Stevens last week. Now, if we review the macro environment, resources investment is likely to decline quite sharply over the next few years. And whilst we've seen previous interest rate reduction helping to provide some stimulus to the interest rate sensitive sectors of the economy really is still adjusting. Overall growth is running below trend, and we've yet to see the non-mining drivers of growth pick up the slack left by softer mining investment. Now, the RBA has stated that it is keen to encourage the rebalancing of growth in the economy, and while the recent depreciation in the currency is providing some support, the inflation outlook is not a concern. So as such, I do think the risk is that we will see further interest rate cuts on the horizon, particularly should demand continue to disappoint. And I think, honestly, the risk is that we could see the RBA cut rates again before the end of this year.
And Amber, the Australian dollar dropped to a fresh 3-year low as sales grew at their weakest pace in 51 years. Now, this was a big reason why many were actually expecting the cut. Can you tell us your views on market performance before and after the decision, and your thoughts on the disappointing figure for retail sales?
I think you're right. Monday's retail sales result exemplifies the RBA's concern that the economy is rebalancing away from strong mining investment-led growth, and it hasn't yet seen the pickup in the non-mining sectors of the economy. So on Monday, we learnt that there was no growth in retail sales in the month of June in nominal terms, nor in real terms for the second quarter of this year. Now, when you consider that retail sales represent around 20% of Australian GDP, the Q2 growth figures are expected to be quite soft. And I think that was one of the major factors driving today's decision by the RBA to cut rates. That is, demand is very weak. Now, interestingly, we've actually seen the Australian dollar rally around 50 pips versus the US dollar following the RBA rate cut, and rates markets sold off about 5 to 10 basis points, so slightly paring back their expectations for future rate reductions. Now, given, as you mentioned, that rates markets had fully priced in a cut today, and all of the economists surveyed by the major newswires had forecast the cut, the reaction actually reflects a bit of disappointment in the market that perhaps Governor Stevens' accompanying statement wasn't as dovish as expected. Now, also remember that a follow-up cut in rates next month has been discounted given the proximity of the RBA board meeting to the federal election that was announced over the weekend. Remember, that takes place on the 7th of September, just 4 days after the next RBA meeting.
And of course, many will also be keeping a close eye on the release of employment data for July on Thursday, and the publication on Friday of new economic forecasts on the economy from the RBA. So what are you expecting to see from these?
That's right, and I think these are the two key releases remaining for the rest of this week in Australia. Now, on the RBA's statement on monetary policy that's out on Friday, I think the risk will be that we'll see a downgrade in the RBA's GDP forecast, so in part justifying its decision to cut rates today. Now, in terms of Thursday's employment report, the leading indicators continue to flag a weak labour market. So today we had the release of the ANZ job advertisement series. That showed a drop of 1.1% in the month of July. It was the 5th consecutive fall in this series. And really, the continuing trend we've seen in decline we've seen in job advertising. It is down by nearly 18% in annual terms. This is consistent with a further modest rise in the unemployment rate over coming months. Now, interestingly, in terms of July's employment outcome, whilst we're expecting a sluggish employment growth print of around 10,000 in the month, weak employment demand could actually see a fall in labour force participation, and as such we actually think the unemployment rate could tick down by a tenth to 5.6%. Now, that's in contrast with the market expectation that we could see a rise in the unemployment rate.
Thank you very much, Amber, for that. Okay, well, viewers, do stay tuned as I will be bringing you an update on Italy later on today. But for now, goodbye.